So I want to thank everyone for your interest in this subject. And Betty and I, as you know, are a mother-daughter team. We've been in the business for about 21 years. And the topic of our conversation today is
retirement, tax deferral, and the CARES Act.
Yes, I'm going to share the screen with you, Tommy. And if you want to tell us a little bit about yourself and want to just introduce yourself.
Sure. Let me just get my screen up here. Okay, so my name is Tom Maldonado, and I'm the owner and CEO of Praetorian Financial Incorporated, and I'm also the regional director for Teachers Pension Consulting. My office is in Old Town Salinas, and I've been in this business since 2012. So I spent a lot of time with school employees and business owners in helping them to plan and prepare for retirement. And the presentation today is focused more on retirement, but how you can use tax dollars to do that, because the last thing we need is more money out of our pockets, right?
Mm-hmm.
So I'm going to teach you some strategies that you may or may not know about where you could leverage tax dollars to save for retirement, because at some point, I don't know if anyone here wants to work for the rest of their lives, but rather than just relying on Social Security, you might be able to put away enough money so that when you do retire from your existing job or your career, that you've put away another nest egg using tax dollars. But we also want to talk about COVID-19 and how it relates to the CARES Act, because some of you may have retirement accounts and such, and you may need some emergency access. So I'm going to discuss some of those items. There's no way I can go into great detail on everything, but going on to the first slide, if it lets me, hold on one second. So there are a couple of ways, 2 or 3 ways here that you could lower taxes, corporate taxes, as well as your personal taxes. So if you're a sole proprietor or an S Corp or a C Corp, there are different tax codes that you can take advantage of. And the first one I want to talk about is establishing and contributing to a SEP IRA, a traditional IRA, or a solo 401k.
Mm-hmm.
And the next bullet point is how you can establish and contribute to an executive bonus life insurance plan using corporate dollars. Now, for myself, I use a SEP IRA, and I also use an executive bonus life insurance, and they work great for me. It's just me. I don't have employees. I'm set up as an S Corp. So for my business structure, this really helps me every year to lower my taxes.
So what is the contribution to executive bonus life? Can you elaborate a little bit on that?
So an executive bonus life, it's all depending on your age and the death benefit. So let's say you're age 30 and you secure a $250,000 death benefit. The premiums could be anywhere from $100 to $150, but then if you want to put extra money into it, that's where it's going to create cash value. But you're able to use dollars from your corporate bank account. So rather than coming out of pocket, you're using money that you would otherwise pay in taxes to fully fund a permanent life insurance policy. So rather than bonus yourself cash, you can actually use that money for life insurance.
Is there a cash surrender value on that life insurance?
Typically on life insurance, there's a 10-year surrender early on. So in the first 10 years, let's say you put in, I don't know, $5,000 a year. Let's say you're in the 3rd year and you have $15,000 of cash value minus the policy costs. Let's say your accumulation value is $12,000. If you were to cash that out, then you may only be able to surrender $9,000 because that money's tied up with the life insurance company. But after the 10th year, then typically your policy is out of surrender. But you can still use the cash provided you don't surrender the policy.
Okay.
Tax-free too. That's one of the advantages. I'll get into more detail on that.
Okay.
These work really well for me. It's not a one-size-shoe-fits-all. So what works for me may not work for you.
Mm-hmm.
Make sense?
Yeah.
So how do they work? A solo 401k, you can contribute up to $19,500 a year before tax if you're under age 50. If you're over age 50, you can contribute $26,000 a year. But these contributions come from the W-2 side. So if you're a corporation and you pay yourself a salary, that deferral comes on the W-2 income. So you can contribute as a W-2 employee of your own company, but the corporation can also match those contributions. So you could also get a tax deduction on the corporate side. So you can actually put more than $26,000 a year into a 401k if you're funding it as an employee of your company and also matching it as a corporation. Kind of like big companies do. You know, you get like a 3 to 6% match.
Mm-hmm.
If you're set up as a corporation and you have a 401k, you could have the same kind of funding going on. But these are typically invested in stocks and bonds, so there's a bit more risk and more volatility, especially right now. A lot of people have lost about 30% of their portfolios, so I don't know if this would be a good fit for everyone.
Right.
But it's certainly something that you could set up. You would be the owner of the 401k, and you're using tax dollars.
So if somebody is not self-employed and they don't have a corporation, they just say they work for Monterey County, they could still set up their solo 401k.
No.
Okay.
So if they work for Monterey County, the county offers what's known as a 457 deferred comp.
Okay.
So they would need to take advantage of an employer-sponsored plan.
Okay.
Exactly. So like in the school districts, teachers use 403Bs. The county, if you work for the police department or you're a firefighter or you're a prison guard, you can contribute to a 457 deferred comp. But if you're in the private sector or a self-employed business owner, you can do either a group-sponsored 401k or a solo 401k.
Okay.
Okay. Now, the next bullet point, this is what I use. It's called a SEP IRA, and SEP stands for Simplified Employee Pension. So there's no cost to set it up. It's a lot easier. There are no administration costs like there are with the 401k. And this is a bit more simple because basically you look at your income. So let's say as a corporation, you're paying yourself $60,000 a year. You can take 25% of that $60,000 and put it away into your IRA. So whatever you contribute reduces your taxable income. And the good thing about a SEP IRA is if you have a bad year, let's say 2020 as an example, let's say none of us have any real profit, you don't have to contribute to either a 401k or a SEP IRA.
Okay.
Okay. Now the third bullet point is a traditional IRA. And this is for someone who doesn't have a business or someone who doesn't have a group sponsored plan from their job. You can contribute $6,000 a year if you're under age 50, or if you're over age 50, you can contribute up to $7,000 a year. And this will also reduce your taxes to some degree. This is not to be confused with the Roth IRA. A Roth IRA does not lower your taxes now. So the purpose of this discussion is tax deferral.
Right.
So Roth IRA would fall under a different category. I don't have the tables in front of me. If you make too much, you can't even use an IRA.
Okay.
Or if you have a 403B or a 401k, then that could also phase you out from being able to use an IRA because the IRS doesn't want you to be able to defer all of your income, right?
Right.
They want you to pay some taxes. So traditional IRA is a very popular choice. But one that is not as well known, but is also a legal provision, is called the Executive Bonus Life Insurance Plan. And I believe the IRS code is section 412E in the IRS code. And the way this works is you have to qualify for permanent life insurance. So this is not term, it doesn't expire. And you fund it with your corporation. So in my case, Praetorian Financial, my business, my company, it pays the premiums for my life insurance. But I have to report that on my W-2 income and on my payroll taxes. So on the W-2 side, I pay the taxes on that contribution that I made, but now the money's sitting on my life insurance policy. is accessible and tax-free for any reason.
Wow, I didn't know that.
And it builds cash value tax-free. The trick is you don't want to take all the money out and let the policy lapse, because if you do, then the IRS will want taxes on the interest that the account earned. So this is
so it's based off of your age. You have to get a physical and all that.
Some of the carriers I work with do not require a physical. They use a government database to gather information about you. So without having to draw blood or pee in a cup, you can go through this route, and then they can arrive at an underwriting decision. And the policies are issued a lot quicker than if you went through the traditional way. So a lot of the big companies are getting away from the old way of having to see a nurse and do all that. But if you have a really bad health history, or you're on a lot of prescriptions, there are certain things that would get you disqualified. So like I was saying, this may not work for everybody. Now, the other thing too is if you're the owner of a company, you can actually discriminate among your top employees as to who you want to give this to. Whereas with the 401k or a SEP IRA, you have to make it available to everybody. With the life insurance, you can say, you know what, I want to reward my top executive. So you can actually take out a life insurance policy on your top executive and use this as a way to bonus your top executive. So you're getting away from, well, I don't like to use the word discriminate, but the IRS uses that word. You can discriminate among your employees. So you can give this to your top performers, and then the rank and file, they may or may not qualify for this. But it's phenomenal. I mean, I've been using mine since 2013. I've used it twice. I used part of it for a down payment on a house that I bought from through Vanco. Sorry, Vanguard is a
movie company.
Sorry. My down payment did not come from a bank. It actually came from my life insurance.
Oh, interesting. I didn't know that.
And these average 7% interest every year. Mine pulled in about 11%.
That's good to know. I might want to do that after we get past this COVID.
Is that
I would say
different
my favorite one is life insurance.
What, Betty?
Can you guys hear me okay? I know my service is bad.
Yeah.
Okay. Is that in the 401k, the interest, where does that interest come from? Is it like invested in bonds and stuff that can shift?
Yes. So solo 401ks are required to have 3 asset classes: stocks, bonds, and cash. And then you can you can determine how you want that invested. So if you want to take a lot of risk, then you would have a higher allocation to stocks. But if you're more conservative, then you can have more in bonds and cash.
And it's the same with that executive bonus life insurance plan?
No. So the executive bonus life insurance plan, well, if you went with the variable life insurance, yes, it would be tied to the market. But the one that I use is an indexed universal life. It's tied to the S&P 500, but I have a cap of how much I can earn, and I have a floor of 0%. So if the market crashes, I don't lose a single penny. I just zero out for that year. So I have the upside of the market with certain limitations. Last year it was 11%. Right now it's about 9%. And if the market takes a hit, which it has now, I don't see any growth, but I don't lose a single penny as well.
So typically, because I have life insurance on Mark and I, we pay based off of our age. You know, is this like that, or can you contribute as much as you want?
So the age and the death benefit will determine how much you can put into it. So let's say, in my case, I have a policy and it allows me to put in roughly $8,000 a year.
Okay.
If I wanted to put more money into it, I would have to get more life insurance because the IRS regulates it.
Okay.
Because the wealthy used to abuse this decades ago. It's been around since 1913.
Okay. Interesting.
So, yeah.
So you said that when you pull money out, you don't have to pay taxes on it?
No, because I pay taxes on the money before I put it in, right? But remember, I'm funding it with my corporation, so I get a tax deduction on my corporation, but I have to report it as income as a W-2 employee. So there is some taxation before the money goes into the policy.
Mm.
But now all the cash value grows tax deferred, and you can take withdrawals and loans tax free. That makes sense?
Yep.
Yeah, that's cool.
Yeah, so these are really popular plans. Again, what works for me may not work for you. Maybe a solo 401k would work better for someone, but I really love what I'm doing, because if I have a bad year, I don't have to really put anything away. Whereas with the life insurance, you have to make the minimum premiums to keep the policy in force, right? So I don't have to put in large amounts of money, but I do have to at least put the minimum premium in because I am paying for life insurance. Okay.
Okay.
So with COVID-19, the tax filing deadline is now July 15th. And this also applies to contributing to an IRA. So if you still have taxes you got to pay like I do, I'm still able to put away a contribution to my SEP IRA by July 15th. So as long as you file for that extension, that applies to your IRA contributions. And you still have to pay the taxes at some point, right? But this is definitely going to reduce the amount of taxes that I'm going to have to pay. Whereas with the 401k, it has to be funded during each calendar year. So you can't go back and make a deposit. Typically with an IRA, you have until April 15th of each tax season to make the contribution for the year that preceded it. So this contribution I'm making is for 2019.
So who would we consult about how much to put in those IRAs in order to reduce how much taxes we have to pay on July 15th?
Your tax person, right?
Yeah, you need to talk to your tax person because they're able to plug those numbers in and give you an exact number. So it's kind of a formula. It's not a dollar for dollar deduction. So they're going to have to take a look at your income, and then on the IRS software, there's a place for them to plug in the IRA contribution, and then that will tell you what the bottom line would be. So you can't just randomly say, oh, I want to dump in 15,000, because if you didn't have the income, then you would get penalized for making an over contribution. So make sure you work with your tax people when you make a SEP or a traditional IRA. Whereas with the life insurance, it has nothing to do with the IRS. It has everything to do with the death benefit that you have. That was a good question. Any further on this topic here?
Nope.
Okay.
Nope.
Now, because of COVID-19, we have what's known as the CARES Act. So this applies to you if you already have retirement accounts. So if you already have a 401k or an IRA and you need emergency access because of COVID-19, you can withdraw up to $100,000 with no 10% IRS penalty. Normally, you have to wait until you're 59 and a half to withdraw from an IRA without incurring the 10% penalty. But that is waived because of COVID-19 under the CARES Act. Now, let's say you took the money out. Let's say you had $60,000 in an IRA. You can actually withdraw that money. No taxes would be due if you return the money before 3 years have elapsed. Or if you don't put the money back, you can spread out the tax liability over 3 years. So you wouldn't have to take a $60,000 the taxes on a $60,000 distribution in 1 year. You could spread it out over 3 years.
And how long do you have to withdraw that money? Like, is there a deadline? You said it's retroactive to January 1st, but is it like you have to do it by June 1st to fall into the CARES Act, or July 1st? Do you know if there's a deadline?
I haven't seen the deadline. It's just whenever the IRS says you can't do it anymore.
Okay.
So as it is right now, because of COVID-19, they haven't lifted this. So you can go back to January 1st, and there's really no cap on it right now until we could get out of this virus.
Okay.
That I know of. I haven't seen anything or heard anything.
There is a withdrawal fee on that though, right? And I think it's less than like 1%. like the company charges a withdrawal fee.
If it's an annuity, yes. If it's a life insurance, yes. If it's a mutual fund, something that is tied to the market, then no, there are no surrender charges.
Okay.
They might charge you a processing fee of $15 to write the check and send it out to you. But this also
Well, we know somebody that actually it's somebody that we're working with, and they had pulled out money, or they're going to pull out money out of their they just called it a retirement account, but they're having to pay the 10% penalty.
I think it's a 403k.
That's where the next slide comes into play. To qualify for the provision under the CARES Act, you or your spouse or dependent have to be diagnosed with COVID-19,
Mm-hmm.
or you have suffered financial consequences such as quarantine, reduction in hours, you're unable to work due to childcare or other issues out of your control.
Mm-hmm.
But not all retirement companies, from what I've been reading, are up to speed. So make sure you check with your provider. So if you have an account with Fidelity Investments, or you have one at Bank of America, or you have one with one of the life insurance carriers or annuity carriers, you want to make sure that you call your provider and ask about the CARES Act provision as it relates to your account.
Well, and this is really a nice provision for the fact that, you know, a lot of people are looking into loans. They're going to pay, you know, like personal loans are going to pay 10, 15%, where this, you're basically taking a loan against yourself with no interest. You just have to pay it back in 3 years.
Exactly. You're basically becoming your own financial institution. And what I like about my life insurance is when I make a withdrawal, I don't have to pay it back.
Mm.
So in that respect, my life insurance is better than my SEP IRA because I don't have the IRS regulations.
But you can only contribute up to $8,000 per year. Like
Yes, that's because I don't have a huge death benefit on it.
Yeah.
Exactly.
Okay.
Now, here's another topic that would concern someone who is a little bit older. So prior to 2020, you required to take required minimum distributions when you reach age 70. So let's say you have an IRA or you have a 403B. The IRS says when you reached age 70, they wanted you to start pulling from that account. But now the age is 72.
Mm-hmm.
So if you have money locked up in a retirement account, you have until April 1st of when you turn age 72 to begin distributions. So that's right around 5% of whatever's in the account. The idea behind it is the IRS wants to tax you before you die.
Mm.
So you can't touch it till you're 59 and a half under normal circumstances, but you have to touch it by the time you're 72.
Mm.
Due to COVID-19, these required minimum distributions have been suspended for 2020. So if you turned the age this year, you don't have to worry about taking your distribution. Just make sure you check with your provider.
Okay.
Now here's the kicker. Under normal circumstances, if you do not take your required minimum distribution, let's say you forget about it, the IRS will impose 50% penalty on the amount you were supposed to withdraw in addition to federal and state taxes.
Wow.
You're looking at about a 90% penalty. I'm sorry, 50% penalty plus the 30 to 40% federal plus your state taxes. You're just going to get hammered for not remembering to take out your RMD.
Yeah, I mean, why wouldn't you take it? I guess to avoid having to pay taxes, huh?
Right. Normally it's because people don't need the money.
Mm.
Or what about the fact that because the market for 401ks have reduced? Is that possibly a reason?
Yeah, absolutely.
So they want to wait until it gets better?
Exactly. Or it could be they're still working, and under those circumstances, if you're still employed, typically you do not have to begin an RMD. So if you're 73 years old and you're still working, I had a teacher who was still working and she was already 70. She didn't have to take her RMD, but she's retiring this summer. So next, if she turns 72 is when she'll have to begin. But a lot of people don't want to take it because they don't need it.
Hmm.
So just be aware of that. The RMD rule applies when you reach age 72,
Okay.
except for this year because of COVID-19. So action plan, speak to your CPA or your tax professional about some of these tax codes. What we do is we design retirement plans and other benefit packages. I'm also a broker with Aflac. We design benefit packages based on the needs of a particular company or business owner. So it's not we're trying to shove everyone into one type of plan. It's designed for every person. And we can typically save a taxpayer, if you're a corporation, between 30 and 40% in corporate taxes.
Wow.
That's huge.
That's
But
really
it
huge.
takes some careful planning, right? So yeah, speak to your CPA tax professional. You can call me with any questions.
And what is your number, Tommy?
831-540-5472. That's the best way to reach me. And make sure you call your provider about these provisions if you need access. So you can take a loan against your 401k, you can take a withdrawal. Just make sure you call your provider, if it's Fidelity or Vanguard, whoever it is, and they'll be able to answer your questions.
Well, very informative. So do you see anything else that's coming down? Oh, there's your information right there. Do you see anything else that's coming down with the COVID-19? Have you heard anything on the other stimulus packages or anybody that you know as far as if they've applied for any type of those loans, if they've gotten it?
Yeah, I've talked to a few, including myself. I still haven't seen a penny from any of those provisions. So I'm just going to move forward as if I'm not going to get any assistance.
Yeah.
But, a lot of people.
Big companies have gotten some assistance.
Well, you know what's kind of messed up is a lot of the big corporations, they applied for the small business loans when they weren't even supposed to. And the banks were shuffling the applications and they were favoring these big corporations because it meant more money in their pocket.
Mm-hmm.
So that's why the money ran out quickly. And the small business people like us, we didn't get squat because the big corporations were sucking it up.
Yeah.
So there's probably going to be some fallout. There might be some lawsuits. There's definitely going to be some fallout. I know some companies have returned the money, like Ruth's Chris, the Los Angeles Lakers. I read that those two corporations, they returned the money because they were like, hey, I guess the small businesses need it more than we do. But I have also been reading.
You almost had to be mad at the Lakers, Tommy.
I know. I can't believe that they gave it back.
Oh, now they're your hero because they gave it back.
Yes.
Yeah,
They made it good.
of that. Yeah, proof.
I just read an article, so I'm at the mercy of the news, just like everybody else.
Yeah.
But yeah, that will wrap it up for me. That's pretty much what I wanted to discuss with you. I'm sure there are many other topics that you might have questions about. Again, you can reach me at 831-540-5472, or when the shelter in place is lifted, we can meet at my office in Old Town Salinas. But at any rate, just give me a call. We can schedule a Zoom meeting.
Where is your office in Old Town? What's it by?
It's right across from Bank of America. So I'm in the Foresters building right above the Salinas Sports Tavern, which is no longer there. Used to be Penny Farthing.
Oh, yeah. I know where you, Bar Locker Insurance used to be over there too, right?
Yeah, they're still there. I'm right above Bar Locker in
Okay.
Suite 2.
Nice.
Yeah.
Yeah, very informative. Thank you very much for taking the time out to do this. We appreciate it. I definitely know somebody that I want to send this to. So.
And Tommy, if you have any other like small business people or, you know, anyone that might be able to contribute to the topics that we discussed, that just common questions that people have. I posted on our Instagram today kind of a formal post saying that we're doing these, and, you know, we're trying to get answers to common questions. There's a lot of hearsay. There's a lot of stuff on the media. And so we would like to go directly to the professionals, specifically local, local business owners that are skilled in these professions and know more details on certain subjects that are concerning people today. So
Sure.
if you have anybody in mind that you want to send our way to, let us know, and then we'll try and keep doing these on every Thursday.
Sounds good.
Thank you, Tommy.
Okay, girls.
Well,
Bye.
thanks, Tommy.
Welcome.
Bye.
Bye.